The hidden impact of home sales on your Medicare costs. When you sell your home after decades of ownership, the transaction can have an unexpected financial consequence. The gain you realize from that sale may increase your Medicare premiums approximately 2 years after the transaction closes. This occurs through a mechanism called the Income-Related Monthly Adjustment Amount, or IRMAA, administered by the Centers for Medicare and Medicaid Services, CMS. The cost does not appear when you sell. It appears about 2 years later in a letter, long after the decision is final and the proceeds have been spent. Most people never connect the two events, seeing only a Medicare bill that has increased without obvious explanation. Unlike a normal income spike, this surcharge typically cannot be appealed because selling a home is considered a voluntary financial decision. The result is a cost that arrives late, is difficult to challenge, and catches many careful retirees by surprise. How the mechanism works: the 2-year look back. Your Medicare premiums are not uniform across all retirees. While most beneficiaries pay a standard monthly amount for Medicare Part B, medical insurance, and Part D, prescription drug coverage, higher income retirees pay an additional surcharge on top of the base premium. This surcharge is called the Income-Related Monthly Adjustment Amount, IRMAA. The critical factor determining your IRMAA is not your current year's income, but your income from 2 years prior. The Centers for Medicare and Medicaid Services, CMS, examines your tax return from 2 years earlier to calculate what you will pay in the current year. This is called the 2-year look-back period. Here is why this matters for home sales. When you sell your home and report a capital gain, your Medicare premiums remain unchanged throughout that year and the following year. Everything appears normal. Then, approximately 2 years after the sale, the system reviews your tax return from the year you sold, identifies the large gain you reported, and recalculates your premium upward. The letter arrives long after the sale, long after the money is typically spent, and long after you have made the decision that cannot be reversed. The income that drives the IRMAA surcharge is calculated broadly. It includes your wages, if any, your interest income, your dividend income, your retirement account withdrawals, and yes, the capital gain from selling your home. A single home sale, although it feels completely separate from your regular income stream, gets added directly on top of everything else for that 1 year. This can elevate you from a moderate income tier into a much higher one, where the surcharge is substantially greater. The cruelty of the timeline deserves emphasis because it determines whether people can plan for this cost. You sell your home in a given year and report the gain to the IRS. That entire next year, your Medicare premiums look completely normal. You have no warning signal. You have no indication that anything unusual has happened. You spend the proceeds, you settle into your new residence, and the home sale fades into memory. Then, well over a year after you sold, the system finally processes the information. It pulls the tax return from the year you sold, sees the large gain, and recalculates your premium accordingly. The letter arrives. By then, the connection between the sale and the increased bill is so separated in time that most people never make the link. They see a Medicare premium that has suddenly jumped and have no understanding of why. They do not realize that a decision they made nearly 2 years earlier is responsible. The real numbers. How large can the surcharge be? Understanding the dollar amounts involved is essential because the magnitude surprises many people. The figures vary based on your income level, marital status, and the size of your home gain. It is important to be direct about the maximum possible scenario while acknowledging that most people will fall below this ceiling. Consider someone who purchased a home decades ago for approximately $175,000. Over the years, as the surrounding area appreciated, the property value increased substantially. By the time they decide to sell, the home is worth nearly $800,000. This represents a gain of roughly $600,000, which is a wonderful result from a lifetime of ownership and responsibility for the property. Now suppose this is a married couple. In the year they sell their home, they also have their regular retirement income, perhaps around $60,000 to $70,000 between them annually. When you stack the enormous home gain on top of their regular income, their total income for that single year becomes approximately $750,000. According to the CMS IRMAA tables, this income level places them in the highest surcharge category. At the highest tier for 2024, the IRMAA surcharge on Medicare Part B, medical coverage, is approximately $487 per month for each individual. The IRMAA surcharge on Medicare Part D, prescription drug coverage, is approximately $91 per month for each individual. Together, these surcharges total approximately $578 per month in additional costs per person. Since this is a married couple, each spouse on Medicare pays the surcharge independently. Therefore, you must calculate the cost for both individuals. 2 people, each paying approximately $578 per month in surcharges, for 12 months equals approximately $13,872 in additional Medicare costs triggered by a single home sale in 1 year. To be entirely transparent, this represents the maximum possible scenario. It assumes a very substantial capital gain, a married couple with both spouses on Medicare, and both landing in the highest IRMAA tier. For the majority of retirees, the actual surcharge will be considerably less than this figure. Perhaps the capital gain is smaller, placing you in a middle tier. Perhaps you are single, meaning the cost is not doubled. The real figure for most people could be half of this maximum, or 1/3, or less. However, here is the critical point. Even a fraction of the maximum is still a very substantial, bill, very unexpected bill. Even a middle-tier surcharge, even for a single person, can mean several $1,000s in unexpected costs, all resulting from one home sale. The exact number will vary enormously based on individual circumstances. What does not vary is that if you have a significant gain on your home, there will very likely be an IRMAA surcharge waiting for you, and this is something that must be known before you sell. For a more typical situation, consider a couple with a solid but not enormous gain who land in a middle IRMAA tier and face a surcharge of several $1,000s for the year rather than the full maximum. This is still an unwelcome cost, but substantially less than the worst case. A single person with a modest gain above the exclusion threshold would face a smaller surcharge still. One additional factor makes IRMAA particularly important to understand. The surcharge structure operates in steps, not on a smooth gradient. The moment your income crosses into a higher tier, even by a single dollar, you pay the full surcharge for that entire tier for the complete year. Two people with nearly identical incomes can pay substantially different amounts if one crossed a tier threshold by just $1 and the other remained below it. This is why, when a home sale is involved, the precise size of your capital gain matters significantly. A gain that places you just barely above a threshold can cost nearly as much as a gain that places you far above it. The benefit structure is not smooth, it is a staircase, and each step upward represents a real jump in cost. Why this trap creates unique financial pain. Many sources of income can increase Medicare costs. So why does the home sale scenario sting particularly hard? 3 specific reasons explain why this trap is uniquely painful. The first is the 2-year delay. Because the IRMAA surcharge is based on income from 2 years prior, the bill does not arrive until long after the sale has concluded. By the time the letter arrives, the money from the home sale is usually completely spent. It has gone toward a new residence, been distributed to family members, or been invested. You are then hit with a substantial cost resulting from a financial decision you made 2 years earlier using money you no longer have available. There is no warning period. There is no advance notice while you still have the proceeds. Just a letter, arriving years late, requesting significantly higher payments going forward. The second reason is the appeals process. In most cases, beneficiaries cannot appeal an IRMAA surcharge. The Centers for Medicare and Medicaid Services does have a process for requesting relief from IRMAA, but it is restricted to specific life events. This process recognizes changes such as stopping employment, the death of a spouse, or a significant reduction in pension income. These are events that genuinely reduce your ongoing income. Selling a home is not included in the list of qualifying events. It is classified as a voluntary financial decision you chose to make. When you contact CMS or your Social Security office to explain that the gain was a one-time event and does not represent your true ongoing income, the response is typically no. The door for appeal is closed. You chose to sell, and the surcharge stands. This is the aspect that produces the most frustration, particularly because with other types of income spikes from recognized life events, there may at least be a path to relief. With a voluntary home sale, that path is closed before you even begin. The third reason is the cliff effect. The IRMAA surcharge does not increase gradually as your income rises. Instead, it operates in distinct tiers, crossing from one tier into the next, even by a single dollar, triggers the full surcharge for that tier for the entire year. There is no gradual phase-in. There is no soft landing. If you are $1 above the threshold, you pay the complete surcharge for that tier for all 12 months. A home sale that pushes you just barely over a line can cost you as much as one that pushes you far over it. Together, these 3 elements, the delay, the restricted appeals process, and the cliff effect, combine to create a cost that is delayed, difficult to contest, and punishing if you fall near a threshold. Any one of these factors alone would be problematic. The combination of all 3 makes this situation particularly worthy of advanced planning. The primary residence exclusion, your main protection. The most important defense against this trap is a feature of the federal tax code called the primary residence capital gains exclusion. When you sell your primary home, the house or condominium where you actually live, federal tax law allows you to exclude a substantial portion of your capital gain from taxation. This excluded gain does not count as income for IRMAA purposes either. For a single person, you may exclude up to $250,000 of capital gain from your primary residence. For a married couple filing jointly, you may exclude up to $500,000. This is an enormous protection because it means that for most retirees whose home appreciation falls below these thresholds, the sale of a primary residence may not trigger any IRMAA surcharge at all. To utilize this exclusion, certain requirements must be met. The home must be your primary residence, the place where you actually live, not a rental property or a vacation home. You must have owned the home and lived in it for at least 2 of the 5 years prior to sale. You cannot have used this exclusion on another home in the 2 years before this sale. For married couples, both spouses generally must meet the 2-year ownership and occupancy requirement to claim the full $500,000 exclusion. Meet these conditions, and this exclusion is the single most powerful protection standing between you and the IRMAA surcharge. The practical impact of this exclusion is substantial. Imagine a couple who purchased their home for a reasonable amount decades ago and sell it years later with a gain that, while genuine and meaningful, falls under the $500,000 married exclusion. For them, that entire gain can be shielded from income that drives the IRMAA calculation. So even though they made a healthy profit on their home sale, their Medicare premiums may not increase at all. The IRMAA surcharge trap never activates because the exclusion fully protects them. This is the situation for a significant portion of ordinary retirees, which is why you should not automatically assume this trap applies to you. The danger zone appears when you have a long-held, highly appreciated home where the gain has grown large enough to exceed the exclusion. Only that portion of the gain above the exclusion, the spillover, flows into your income calculation and potentially triggers the IRMAA surcharge. This makes a simple question essential. Is your likely capital gain comfortably below the exclusion threshold, or has your home appreciated so substantially that a significant portion will exceed the shield? Knowing which side of that line you fall on tells you almost everything about whether the IRMAA surcharge applies to your situation. Strategies to reduce or minimize the impact. If you understand this trap before you sell, you have several options to reduce it or avoid it entirely. Adjusting your cost basis. Your taxable capital gain is not simply the selling price minus your original purchase price. You also have the opportunity to add to your basis, your starting number, through the cost of significant improvements you made to the property over the years. A new roof, a new HVAC system, an addition, a major kitchen renovation, updated electrical systems, or a new foundation all count as capital improvements. Each one raises your basis, which directly reduces your taxable gain. Since it is the gain above the exclusion that triggers IRMAA, reducing the gain can keep you below a threshold or in a lower IRMAA tier. The critical requirement is documentation. You must have records proving the cost and the date of these improvements. If you have owned your home for decades and invested real money in substantial improvements, gathering those records now, before you list the home, is genuinely worthwhile because it can reduce the gain that would have triggered the IRMAA surcharge. The homeowner who kept careful records and receipts for roof replacement, kitchen renovation, bathroom update, and HVAC replacement can document all of this work and reduce the taxable gain accordingly. The homeowner who performed identical work but did not retain the documentation cannot substantiate it and ends up with a larger gain and higher IRMAA risk. The house is identical. The improvements are identical. The outcome is different, determined entirely by whether the paperwork was preserved. If you have owned a property a long time, beginning now to locate and organize records of all major improvements is an important step toward managing IRMAA exposure. Timing. Considerations. Because IRMAA is based on your income in the year of the sale, timing the sale during a year when your other income is lower can reduce your total income for that year and potentially keep you in a lower IRMAA tier. If you have flexibility in the timing of your home sale or in how the closing occurs, consider whether selling in a year with lower other income would provide a benefit. Additionally, if there is flexibility in how the sale proceeds are structured or paid, spreading the income receipt across multiple years rather than receiving everything in a single lump sum can sometimes help manage tier placement. This requires professional coordination and is precisely the kind of planning that should occur with a qualified tax advisor before you sell, not after the sale is complete. Understanding the rental property exception. The primary residence capital gains exclusion applies exclusively to your primary home. It does not extend to rental properties, investment properties, or vacation homes. If you are selling a rental property or second home, the entire capital gain is subject to income calculation with no exclusion to protect you. This makes IRMAA surcharges far more likely and potentially far more substantial. If you own investment property or a second home and are considering a sale, this situation requires even more careful planning because you cannot rely on the large exclusion that protects primary residence sales. Complete planning checklist. Here is a systematic checklist to guide your planning if you are considering a home sale. 1. Understand that a substantial home gain can increase your Medicare IRMAA surcharge approximately 2 years after the sale due to the 2-year look-back period on your income tax return. 2. Determine whether your expected capital gain will fall within the primary residence exclusion. If you are single, understand that up to $250,000 can be shielded. If you are married, understand that up to $500,000 can be shielded, provided both spouses meet ownership and occupancy requirements. 3. If your anticipated gain exceeds the exclusion, begin now to gather documentation of all major home improvements. Receipts, contractor invoices, and dated records of capital improvements reduce your taxable gain directly. 4. Consult with a qualified tax professional or financial advisor to estimate your capital gain. Verify your qualification for the primary residence exclusion, and determine whether your gain might trigger IRMAA surcharge and at what level. 5. If the sale will likely trigger a significant IRMAA surcharge, explore whether timing the sale into a lower income year or structuring the transaction to spread income across multiple years might reduce your IRMAA exposure. 6. If you are selling investment property or a second home, plan carefully because the primary residence exclusion does not apply and your entire gain may be subject to income calculation. 7. Do Do not count on appealing an IRMAA surcharge resulting from a home sale. Voluntary home sales are not among the qualifying life events that permit an IRMAA appeal. All planning must occur before the sale, not after. 8. Run your own projections and calculations, ideally with a qualified professional, before you list the home. Walk into the largest financial decision of your retirement with complete information, not with a surprise waiting 2 years down the road. The broader context: making an informed decision. This information is not intended to discourage you from selling your home. Selling a home is often exactly the right financial, health, and personal decision. It can enable you to relocate to a place you love, reduce the burden of maintaining a large property, move closer to family, or access cash that supports your retirement lifestyle and goals. None of the IRMAA implications are reasons to avoid selling if that move serves your overall well-being. The purpose of this information is to help you sell with complete knowledge of all consequences, enabling you to plan accordingly. A little foresight does not just save you money in IRMAA costs. It allows you to make one of the largest decisions of your life calmly, with full information, understanding all the moving parts, rather than discovering an unexpected cost long after the choice is irreversible. That clarity and preparation, that ability to decide with your eyes open rather than being surprised, is valuable in itself. The difference between the retiree who plans ahead and understands the IRMAA mechanism before selling and the one who learns about it 2 years later in a letter is not luck. It is simply knowing that this rule exists before the sale rather than finding out after. You worked a lifetime to build the value in your home. With advanced planning and understanding, you can preserve that value and protect your retirement finances from an unexpected surcharge. The trap is real, but it is also one of the most avoidable traps in the retirement system if you understand the rules before you act. Final guidance: if you are planning to sell your home in the coming years, or if you are helping a family member navigate this decision, the single most important step is to consult with a qualified tax professional or financial advisor now, before you list the property. Bring your property documents, your records of improvements, your estimated home value, and your current income information. Ask them to estimate your anticipated capital gain, verify your qualification for the primary residence exclusion, and calculate whether an IRMAA surcharge might apply and at what level. The Centers for Medicare and Medicaid Services provides IRMAA threshold tables annually. Social Security Administration offices can provide preliminary estimates of your IRMAA. The IRS provides guidance on capital gains and the primary residence exclusion. These are official sources with authoritative information about how your home sale will affect your Medicare costs. Selling your home should feel like the achievement it is, the reward for a lifetime of building equity and maintaining your property. With advanced planning, it can be exactly that, a positive financial transition that improves your retirement circumstances. Understanding the IRMAA mechanism, planning around it, and working with professionals to structure your sale properly ensures that you keep the financial benefit of your home where it belongs, with you.